Hello and welcome to today's seminar, our mid-year update on women and minority-owned firms. With me today and joining me, my name is Joanne Price, one of the co-founders of Fairview Capital. And with me today are my two partners, Kwesi Quay and Akar Vashani. And we are pleased to present to you today a program on women and minority-owned companies. As you know, or you may know, Fairview was founded in 1994. And one of the main reasons that we started the business was to be able to build a diverse manager across the country. And we have successfully been able to do that. Today, we have close to 10.5 billion that we have of aggregate fund capital that we have developed over since inception. We focus on delivering strong adjusted private market returns. And we have been now in business close to 25 years. So we're very pleased, close to 30 years actually. And so we're very pleased to present to you today this particular area of focus. As I indicated earlier, today we're going to be focusing on diverse and the emerging manager category. So we want to be able to speak to the experience that we have had in developing excellent specialists in this field and venture capital and private equity firms from across the country. And both Akar and Kwesi will be discussing the programs, where we are today, and what we have been able to develop over time. So without further ado, I'd like to present to you Akar Vashani.
Right, thanks, Joanne, for the introduction. I also just echo that we're really happy to be here today to share some of our insights and also have a bit of a conversation as well through the Q&A. And to be honest, the turnout that we have today is way beyond what we expected. So it's great to know that the energy and interest and curiosity around what's happening in this part of the market matches ours. So we'll spend a little bit of time talking about why we're doing this. A couple slides kind of forward from here, just an overview of our commitment here to knowledge sharing. So the first reason is simply that this is part of our philosophy. We've never taken it for granted, and we certainly don't take it lightly. Kind of after all the work that's gone into building this firm, we find ourselves in a pretty privileged position of sitting at the intersection of some of the most important institutional investors in the world and some of the most enterprising and innovative firm and company builders in the world. And we think there's a lot of responsibility that comes with that. And part of that for us in making sure that we share our data and insights into what's happening. And then that's really important because we believe that complete accurate information about what's happening in private markets is hard to come by, especially on the diverse and emerging manager category. And the more prepared you are, we think the more successful you can be. And given our history and work in this space across 30 years almost, as I mentioned, we think we've been fortunate to be able to build what we think is the largest database in the industry on women and minority-owned firms in the private markets. And we know that's a valuable resource. And so the information that we're going to share, we think, is an important part of engaged stakeholder, regardless of, what ways in which you touch this ecosystem. The other reason we're doing this update is that it's a really critical time in the evolution of the ecosystem. And there's some kind of points on this on the next slide, but the reasons, it's important is that it should really be no surprise to anyone, that market cycles have a big impact on the institutional capital that's available to diverse and emerging managers in particular. We've seen it several times over the history of Fairview. What's different this time is that we're coming off of record years of new firm formation, and the diverse talent that's entering the industry, has been very significant. So the stakes are simply just higher. And then you combine that with the fact that there simply hasn't been enough headway made around biases and the challenges that exist in accessing capital all of which still very much exist. So we feel that what LPs do and what GPs do over the near to midterm will really have a big impact on the future. And if you were to ask us, based on our experience, now is not likely a good time to pull back. But unfortunately, it is something we typically do see. So no question, it's more challenging to GPs and LPs in terms of navigating this market. But we do feel like being informed and intentional is what really can drive the results that everyone is looking for. And then, before we get into the data, just a quick introduction to the data. It's the same data source. We figured it'd be helpful to share kind of where the data comes from. So it's the same data source we've been using to publish our public reports on the topic for almost a decade now, which is data that's directly from our proprietary internal database, which is exclusively commercial firms that are majority women and minority owned, based in investing in the US. And we collect this data through our engagement in the market, through research on diverse firms that are raising capital. This takes a lot of work. We're kind of proactively constantly engaging with folks raising capital in the ecosystem with direct meetings. So there's a lot of time and effort that goes behind the data that you're going to see today. And then the vast majority of what we will cover today are firms that are actively raising capital this year. And that's very deliberate. We want to bring focus to the investment opportunity with women and minority owned firms as it currently exists. And that's what's actionable. And we'll take a look at that data across several dimensions. So with that, I will pass it on to Kwesi.
Sure. Thanks, Ricardo. So let's dig into the numbers. So at the highest level, the universe of women minority-owned firms continues to grow despite changing market conditions. It's worth noting that in 2014, there were just over 100 women and minority-owned firms in the industry. Through the first half of this year, we're tracking approximately 831 firms, meaning the universe has grown approximately 7 times in size over the last 8 years. This trend also reflects a 27% compound annual growth rate, which is really indicative of strong firm formation over several years. Now, when we look at where we are today, through mid-year, new firm formation remains robust despite a more challenging fundraising environment. When we annualize the mid-year results, new firm formation is on pace to exceed the record set over the previous 2 years. It's important to note that launching a new firm is a significant endeavor and can have a long lead time between the ideation and launch phases. So it will be interesting to see the opportunity set during the balance of the year. But so far, the results look quite strong. A question we often get asked at Fairview is, what is driving the growth in the universe of women minority-owned firms? We think there's 4 main reasons. For one, there's increasingly more diverse talent in the industry. This year, we continue to observe increase in diverse talent entering the industry with operating and investing backgrounds. This is inclusive of angel investments. Second, many diverse professionals experience limited career advancement at tenured firms. This has led some to build the conviction to start their own firm. Our observations confirm limited career advancement continues to be a challenge, which could bode well for new firm formation. Third, diverse managers are invigorated to develop a new firm with an inclusive first culture. Diverse managers are reshaping the industry, grounded in the knowledge that cultures that truly embrace diversity, equity, and inclusion can outperform. We think organizations that have embraced inclusion are advantaged, recruiting diverse talent, and are building strong brands with this philosophy, uniquely connecting with LPs, GPs, peers, and founders who share similar values are all tailwinds to firm formation in this segment. And then lastly, advice, mentorship, and other knowledge sharing platforms are increasingly accessible for firm building. Our observations confirm that support systems remain robust and general partners are collaborating more than ever. So when we look at this year specifically, all told, 325 women minority-owned firms are in the market this year. Continuing recent trends, first managers represent newer firms, are targeting smaller fund sizes and are primarily focused on venture capital strategies. In the first half of this year, first-time funds sponsored by women minority-owned firms represented 52% of the firms in market, the lowest proportion since 2017. We think there's actually a silver lining with this, as that means 48% are raising successor funds and are presumably building their franchises. From a fund size perspective, the universe is targeting a $100 million median target fund size. And from a fund strategy perspective, 76% are raising a venture capital fund, which is up from 75% in 2022. Now, digging into fund sequence, most diverse managers are raising a first-time fund, but a higher proportion are raising a subsequent fund. This year, highly sought-after diverse managers with strong track records quickly re-entered the market. And we've also noticed managers are increasingly pre-marketing in anticipation of longer fundraisers, which is a shift from recent years. Double-clicking on fund size, as we mentioned earlier, the median fund size for women and minority-owned firms in the market in 2023 was $100 million. That actually compares to the industry-wide median, which is approximately 3 times higher than that. Diverse managers often do not meet minimum size parameters implemented by institutional investors and their intermediaries, including for many emerging manager programs. As such, in this environment, LPs may be inclined to invest in larger funds sponsored by established firms, which is a headwind for diverse managers who may be overlooked. Slide 17 now emphasizes the point that the universe is predominantly raising a venture capital fund. Barriers to entry are higher in growth equity and buyout as compared to venture capital. Ex-venture, we continue to observe that diverse managers in the market are pursuing technology, infrastructure, and special situations strategies. And now we'll look at select demographics to understand the trends within the market. So beginning with African Americans, we note that a significant majority were raising first-time funds this year. African Americans were targeting a median fund size of $75 billion, which is actually up from $65 million in the prior year, and we believe that's driven primarily by step-ups in successor funds. When we look at the universe of Latinx firms, they represent 11% of all women minority-owned firms in the market and are severely underrepresented. However, 49% of Latinx firms are raising a subsequent fund, so there are some early indications that some are building out their teams and growing their franchises. Also, interestingly, Latinx firms are targeting a median fund size of $125 million, which is up from $100 million last year and above the $100 million broader universe of women minority-owned firms. This is driven, again, by successor fund step-ups and venture and buyout strategies. Shifting to Asian Americans, most were in the market with a successor venture capital fund. Further, 80% of Asian Americans firms in the market were raising a venture capital fund, the highest of the profile demographics. And in terms of median fund targets, they're raising $100 million. This is important to note because although they are raising successor funds often, which would imply a step up in fund sizes, Asian Americans are still targeting fund size in line with other represented demographics. Our observations confirm that women-owned firms often raise small, early-stage venture capital funds, while African-American women and Latinos are often raising the smallest of funds. When we look at African-American women-owned firms, we note the following. 77% of African-American women-led firms were raising first-time funds. 84% were raising a venture capital fund. And they're targeting a $50 million median fund size, which is unchanged from 2022. In the case of Asian American women-owned firms, 93% were raising a venture capital fund, and most were raising a successor fund. And when we look at Latino-owned firms, again, very underrepresented. 30% were raising a first-time fund. All were raising a venture capital fund. And the median target fund size for this group is $45 million, which is the lowest of the demographics profile. And then lastly, when we look at non-minority women, 78% were pursuing a venture capital strategy. Most were raising a successor fund, and they were targeting a $75 million median fund size. Now, shifting gears to what that means in terms of the makeup of entrepreneurs, there's some interesting trends that are going on. Given Fairview's positioning in the marketplace, we have amassed a unique set of data on diverse managers and their underlying portfolio companies. This slide conveys real examples of 3 active Fairview fund of funds focused exclusively on investing in funds sponsored by women minority-owned private equity and venture capital firms. None of these Fairview vehicles, nor the sub-funds in the vehicles, have an explicit strategy of investing in women and diverse entrepreneurs. What we can clearly see here is that there's a natural diverse multiplier effect at the portfolio company level, whereby diverse managers are investing in diverse entrepreneurs. In the 3 vehicles, over 2/3 of the portfolio are led by women minorities. These managers, as you can see, are organically tapping into their differentiated networks. We expect to see more deliberate approaches to investing in diverse entrepreneurs over time. And now I'll turn it over to Akar to share some forward-looking thoughts.
Great, thank you, Kwesi. And we forgot to mention at the front end, but we do have Q&A we'll be doing at the end of the presentation, so feel free to submit your questions there and we'll get to them when we wrap up. So yeah, I think, we went through a ton of data there that we dropped in a relatively short period of time. So just to synthesize things into a bit of an outlook for the rest of the year, and then after this, we'll also provide some takeaways for both LPs and GPs. So, first, Kwesi started off talking about new firm formation, which has been, growing pretty steadily and at a pretty rapid pace since we started sharing this data over about a decade ago. And then the second slide that he covered, if you recall, even this year, we're on pace for another record year of new firm formation, which we think would be a good thing if it holds up. But, honestly, we think it's a bit unclear how things will play out there. Usually we find that there's a long lead time, if you will, between the start of an ideation phase that someone has around launching a firm and then when the manager actually enters the market. And a lot of the growth earlier this year, as Kwesi indicated, were managers who had been thinking about starting a firm for a while. And it does feel like we are having slightly fewer of those conversations at the ideation phase today, which leads us to think that why we will no doubt see a continued growth in new firm formation, because there's clearly more talent that's interested in the industry. It just may not be as linear as we have seen it in the past several years. And somewhat related to that, we don't want to call it a bifurcation, but it does seem to us that there's a subset of firms that LPs have gravitated towards, just even within the diverse manager category. Certainly we see that in the broader market. Often that's due to these firms, and their experience and their track record, but not always. And these are firms that have been able to scale their platform successfully, again, even in this market, even if it takes a bit longer. So again, even within the diverse manager market, a flight to perceived quality, which certainly has some pros and cons associated with it. Kwesi also spent some time talking about fund sizes, and we think particularly what's been striking this year has been the gap that he mentioned between women and minority-owned firms in terms of what they're targeting and what the rest of the market is raising. That has widened very significantly in the first part of this year, and it's kind of the widest that we've observed in a very long time. And if you think about it, it's pretty obvious why that's happening. It's, again, this flight to perceived quality in the market broadly across the private markets. And oftentimes here, it comes at the expense of emerging managers and of diverse managers. It's hard not to see this continuing, at least for the balance of this year. And it is in line, we think, kind of with what we have seen in prior cycles. In terms of the strategy, despite, I think, everything that everyone has been hearing about the reset in venture capital, we do believe that most new firm formation by diverse managers will continue to be in venture for several reasons. Innovation is continuing to accelerate across several dimensions. And that's really the opportunity that venture capital is built on. as a firm, we spend a lot of time talking to the next generation of investment talent, including at the university level. And it's very clear to us that there's just so much more enthusiasm for venture capital. The potential ability to shape the future through technology, including things like AI, biotech, climate tech. It's all very attractive to younger people. It's energizing to them. And then also for the reasons that Kwesi mentioned in terms of the access to the market and the resources that are available and the information that's available that historically was not, particularly about the venture capital industry. I think it's also accelerated that trend. And then finally, we do think that it's worth emphasizing that despite everything going on in the market and the world, the opportunity to invest with diverse firms has really never been greater than it is today. The data is very clear on that. There's absolutely no pipeline problem. We've been past that point, we think, for a very long time. So that's kind of a bit of an outlook for the rest of the year. What does that mean for LPs? Our first consideration here is really that last point that I made, which is that we do not observe a slowdown in either the number or quality of diverse managers in the market. But as we've indicated through the data, the fact does remain that these managers are by and large building new firms. They're raising smaller funds. They're mostly found in venture capital. And when you take that profile, this has nothing to do with diversity, but just because of the profile of these firms, you will continue to see a higher dispersion of returns. And there's a potential that it could get higher. And the thing with return dispersion is that it can be a good thing because it means that the best firms will significantly outperform. Plenty of studies show that diverse teams and firms outperform as it is. So there's no doubt that you can be very successful in this category. But it does mean that market coverage really matters. You need to make sure that you're not missing the best opportunities. And we think that means you need to be more inclusive on the front end, as inclusive as possible, and then drive stringent selectivity from there. And that's really just like you would with any program in venture capital with the same profile. And then finally, very much related to that point, is that you need to be programmatic and take a long-term approach. And the private markets are a very long-term asset class. If funds that you're committing to, they're typically deploying capital over 3 years. That means the 6, 7, 8 years. It's really possible to time the markets today and kind of trying to figure out what's going to be happening when those companies mature, which is arguably more important than what's happening today. So it just takes a lot of patience and a long-term perspective, and that's a general kind of point about private market investing. But we think in this part of the market in particular, with venture capital and with emerging managers, you can't make one-off or point-in-time commitments. If you do that, you open yourself up to a ton of risk. So we do believe that staying the course is ideal. And then for general partners out there, or anybody really on the investment side, the considerations we have for that group are on the next slide. And the reason that we gave some advice that we did right now to LPs based on our experience is that market cycles historically have had an outsized impact on capital that is deployed with emerging managers, and particularly with diverse and emerging managers. And what that means is, like, often emerging manager programs aren't as active. There's less capital available for them. They tend to not have the same priority as other things, or certainly new ones are typically not coming online. Of reasons still play an important role, along with less capital available through other sources, means that pretty obviously folks haven't seen this, but it means that fundraisers will take longer. We're seeing that today very clearly in some ways. Just time that firms are entering to having a final close has been extended. by several months. What we're also seeing is more pre-marketing, and firms kind of reaching out early, even before they're thinking about it, communication with FPs early, and we do think that that can be helpful, and it's part of just being prepared and planning ahead. So that's a big recommendation. And then the final point here is really around community, and community has always been important, but we think it is more important today. We're still at this place where the pie, so to speak, the amount of capital accessible for emerging and diverse firms is small, and there's a really long way to go for a level playing field. We all see the statistics, and we think it can be more beneficial to put energy into growing that pie rather than competing for a piece of it. And there are several great organizations doing great advocacy work and education work to help on that front. Several organizations that have been around many decades, and then several organizations that are new. And we think they all kind of play a unique role, an important role in the ecosystem. We're involved with most of these organizations, so if you feel like you need some direction, feel free to reach out on that front. There's also a lot of great sharing of best practices that happens, which is also important. So it is a good time, we think, to lean into community if you haven't already. So that's what we had prepared for remarks. We kind of figured we would do 30 minutes of presentation and leave 15 minutes for Q&A. We've had several questions come through kind of during the meeting. And we'll kind of do our best to try to get to all of these. And in the event that we don't, we just want to remind everybody that we have an open door policy, so you can reach out to us directly via email. Emails are right on our website, so feel free to reach out if we don't get to your question, or if you want to dig deeper on a specific topic. We are always available. Get to some of the questions, and all three of us, Joanne, Kwesi, and I will address these. So the first one here is a question around how do we reconcile the pace of growth in the number of firms with the growth in AUM of these firms? I think that's a very important question. We talk about growth in terms of the number of new firms in the industry, new firms that are getting started. How does that translate into the AUM growth? One of the things that I kind of hit on, and Kwesi observed the biggest gap between what the industry is closing and what diverse managers are targeting. And it's been one of the largest we've seen in a very long time. So I think that's a great indication of the AUM growth not scaling with the growth in number of firms, especially this year. But Kwesi, you might have additional insights to that.
Yeah, no, I agree with that point. And I just go back to the data. I mean, at the end of the day, we surveyed essentially an entire universe of firms that were in the market this year, many of which were raising first-time funds, but also many of which were raising fund twos or more. And overwhelmingly, the median fund size, which we presented earlier, is still $100 million. So there is not as much firm growth as you would expect by diverse managers when they raise successor funds. And that does bear out in the data. I think for certain demographics, we observed, increasing median fund size targets compared to last year. And that's a result of the step ups. But I think, on range, we've seen somewhere between 20 and 25%, at the highest levels from a fund one to a fund two. And that's, of course, from a very low base. So to answer the question directly, there's been some growth, but it's very minimal relative to the broader market, and that bears out in the data.
Great. Question here around kind of advice for navigating these cycles and how this cycle kind of compares to ones in the past. And I think that might be a good one for you to answer, Joanne. I can't think of anybody that's been investing through as many cycles as you have in this category. So, how does this period compare to periods in the past? It's specifically related to the impact on diverse managers.
I think what has happened over time is that there's been the continued growth. And as that growth began to happen, it actually started first with the buyout side of the business and then became, as you indicated, more focused on venture. But as you have more colleagues come into the business and relationships develop across the country, there's been more opportunity and looking at this as an opportunity to grow firms that are diverse, and people have reached out to each other, people providing helping hands, and of course Fairview has been there, as you indicated earlier, so that we have also been a place to come and talk about building private equity firms. So I think it's happened over time with the folks in the industry, Fairview and others that have entered into the business since we started our own company.
Okay, we have a handful of demographic specific questions, so we'll maybe hit those quickly. One is around, do we count veteran-owned firms in the minority-owned category? And the answer there is not for this data, but we do have several mandates that are specifically focused on veterans. And so we do track that data separately, but it's not part of this data. Another question is around, how do we define African American or Asian owned firms? How do you define minority owned firms? And I think that we had laid out early on, but that's essentially in this study, it's firms that are majority owned by women and or ethnic minorities. Question around Latinx managers and them having the smallest, I think Latinas in particular, having the smallest fund sizes. Do you want to speak to that one, Kwesi?
Sure. I don't think there's one clear-cut answer as to why. But when you look at, some of the trends in the marketplace, we had put up a slide as to why there's been so much growth in the diverse manager market. And I'd outlined basically 4 reasons. And one of those reasons in particular was around the affinity groups and educational resources. And relative to other demographics, there's not as many affinity groups focused on Latinx professionals, and we think that needs to improve, and that would go a long way in terms of building the ecosystem. So that's one thing that I would offer, but it's certainly an opportunity going forward.
Okay, there were several questions kind of specific to strategy, so maybe we can group those together. One is around venture capital. So can we comment on the ability of venture funds to launch and be viable if the fund sizes are smaller? And I think that's a very valid question. That's where we see the smallest fund sizes when you look across the private markets. And then certainly when you overlay diversity, that also holds true. We typically, it is the one part of the private markets where a small fund size can be viable, in our opinion. We've seen the cost to start a company come down dramatically over the last several years. And so, take an idea to a product market fit, even to market, can be done on way less capital than it had required in the past. And that's opened up this new, essentially pre-seed stage of investing, which, are typically smaller fund, round sizes, and where smaller funds can participate in a meaningful way. And, along the way, kind of build a diversified portfolio that's institutional quality, in nature. And so, there's a lot of other factors that would go into assessing whether or not, a smaller fund is viable for an institutional portfolio, or will be viable in terms of those firms being able to scale into a larger platform. It's obviously on a case-by-case basis. We've seen it many, many times where a diverse firm may start off with a small, sub $20 million proof of concept fund, and then eventually go on to raise, over $100 million in subsequent funds. So it's certainly possible, it's certainly scalable in that way. And then even some of the most successful diverse firms today, started out really small. So we certainly think that, there's viability there. But there's other factors, LPs would need to assess before, making an investment. Another question on strategies around private credit, and are we seeing more women or diverse firms in private credit? Maybe Kwesi, do you want to take that one?
We've seen a little bit more, but albeit again from a very low base. We had shown some stats around the universe, and venture is still the story. It's 76% venture, buyout growth equity, pretty much rounded out. And private credit would fall somewhere between other and special situations, which is still less than 5% of the 325 firms that are in the market. But we're seeing more fund formation on that side. Hard to see whether that's a point in time or truly something that's going to be sustainable over multiple funds, but we are seeing more of those this year. Thanks for the question.
Mm-hmm. Another question, this one maybe is a good one for you, Joanne. How does Fairview see some of the backlash across the country around ESG and diversity criteria in public pension funds impacting this space?
Thus far, the impact that we have seen has been relatively positive in the public pension fund space. Public pension funds really have been on the front line in terms of diversifying and looking to do diversity within portfolios. So they have been more proactive than other groups of investors. I think the other thing with respect with, I don't think Fairview has seen any backlash. I don't think that has happened, but I do think that in terms of what's happening now, you see more organizations wanting to embrace diversity, do more in the area, and diverse firms are having the opportunity to present their programs, how they're going to go about it, and how they're looking to build portfolios. So I think on balance, we'd like it to be more proactive because we thought the process would be more aggressive by this time. But having said that, it certainly has not decreased. It has increased. And so we're pleased to see that. And hopefully it will continue over time.
Yeah, I mean, I would agree. I think, pension plans have been such a critical part of this ecosystem from the earliest days, and they remain today kind of, probably still the largest source of capital for managers in this country, either directly or through funds of funds programs. And, some of the challenges we're seeing, that may impact, what mandates are available in the future, but available to date, hasn't really changed, to Joanne's point. There's a related question around what trends are we seeing from LPs and where are they coming from? Is it pensions, endowments, family offices, banks that are seeking maybe CRA credits? What's changed there? And to my point, I think pensions still remain the largest. We've seen much more engagement from endowments and foundations over the last 3 years in particular. And family offices, we think are newer to the category, but had been active. I think all of these groups, have different profiles in terms of how they're impacted by the current market and their ability to continue to deploy capital in the space. Banks were also mentioned, and we saw a lot of banks launch programs in this category, in 2020. And, by and large, I think, they've been pretty active. In a lot of them, I think, have moved beyond being just point in time programs, but they're all relatively new. So I think, it's still a question of, how long and how impactful they will be in the long term, but there's certainly more sources of capital. But as we talked about, a lot of them are becoming a little constrained this year. Another question we have around the male-led diverse firms versus female-led diverse firms, and what the impact or what that means in terms of the average or median AUM in terms of fund size. I guess we had some data on women-led firms, but Kwesi is probably in a good position to answer that one in terms of what we see in terms of gender and the differences there.
There's certainly a difference. We didn't break it out in this presentation, but you could almost infer that women-led funds are raising a little bit less than male-led funds, because when we presented the data, at the top of it, all the demographics, Latinx, and the like, you notice that the median fund size across the board was about $100 million or higher. And later in the presentation, we had presented data on women-owned firms and even broke it out and shown how it looks like for American women, Asian American women, Latino-owned firms, and non-minority women. And for African American women, it was much lower, it's $50 million. And African American as a whole is much higher than that. We talked about Latina-owned firms, typically targeting that $45 million fund size, but then Latinx firms, when we looked at it in aggregate, were $100 million or higher. So yes, if we can deduce that women-led firms are targeting a fund size smaller than that.
Couple questions on Fairview. Fairview changed its deployment pace this year, and what is Fairview looking for in managers? Anything different than before? We haven't really changed our deployment pace. We try to deploy capital evenly across investment cycles. Believe in vintage year diversification. Although we are very different than typical LP, that we raise capital specifically to invest in emerging managers. So I think we're quite different. Talking to our peers across the LP landscape, I think things are quite different. And then what are we looking for in managers? Is there anything different than before? Why don't you pick up on that one, Christine?
You cut out for just a second there, Art.
Oh, sorry. Yeah, it's picking up on kind of what are we looking for in managers, and is there anything different than we would have looked for in the past?
We're still looking for team, performance, and process. It really comes down to those things. I think in this environment, there's certainly been a lot of new firm formation. So underwriting has been a little bit more challenging in the sense that you're seeing more track records focused on angel investments, and more professionals are coming from different backgrounds. But again, it's still the same type of analysis. We're looking at, is the team likely to cohere? Are they likely to build a franchise over a sustainable amount of time? Is the strategy differentiated? Are they focused in areas where perhaps their competition may not have access to? Are they able to attract the best founders? Are they able to implement the right processes so that they can mitigate all the risks associated with any investment? Are they able to build relationships with peers in the ecosystem so that they're able to bring on top tier co-investors and also late stage capital, so that these companies can ultimately get to a point of true scale and be acquired, or either go public so that LPs get their capital back. So no, nothing has changed fundamentally from that perspective, but that's what we're really focused on in this environment. Happy to defer to anybody else if they have any other comments on it.
Yeah, I think you covered it well, Kwesi. And with just a minute left, I think we can start wrapping up. There's several questions around one around how do firms get into our database. I think that's quite easy. If you're an emerging manager, please feel free to reach out to us. We have an open door policy. You can find our contact information right on our website. And then there's also folks who have asked for a summary of the report, as well as a recording of this. What we will do is we'll put up on our website, probably by next week, we'll have a recording of this, as well as the data from the presentation on the website, and you'll be able to access it. And what we'll do is we'll send an email out to everyone that's been on with that information, so that you can get it. A few questions we didn't get to. So again, like we said, feel free to reach out to us directly if we didn't get to your question, or if you want to have a deeper conversation on anything. Really, yeah, we're really thankful for these wonderful questions, very insightful and deep. We also, I should mention, we have report that we publish every year again that this data was based on. So that report is also on our data on our website, and we'll publish a report probably in January or February of next year with more complete data. But with that, everyone for joining. Really happy to host this today, and hope that everyone found it helpful.
Thank you very much.
Thank you, everyone.
Thanks. Bye.
Bye-bye.